3 of how to slash CGT on your investment property. Strategy number 4 is 50% general discount. One of the best ways to reduce CGT is the 50% CGT discount available for individuals, trusts, and superannuation funds, which holds the asset for more than 12 months. What does this mean? If you own the investment property over a year, you only pay tax on 50% of the capital gain. Let's say you sell your property for a $200,000 profit, but you've owned it for over a year. With a 50% general discount, your taxable gain is now only $100,000, which means your tax bill is cut in half. This is one of the easiest and most effective ways to reduce CGT. So structuring before buying the investment property is very important. Strategy number 5 is small business CGT. Many people are unaware that small business CGT concessions can still apply to investment properties. While these concessions are designed to provide tax benefits for small businesses, a passive investment property may qualify if it has been used in the business of a related party. This pathway is called passively held asset. These are the 4 small business CGT concessions. I will go through each one of them shortly. If you qualify for basic conditions under these rules, you can get the 50% active asset discount. This applies on top of the 50% general discount that you previously get. This could be a game changer for reducing your CGT liability. If you want to get small business CGT concessions, you will need to engage tax advisor who provides strategy for you well in advance before you sell. After applying the 50% active asset reduction, the remaining capital gain may be eligible for small business CGT rollover, allowing you to defer tax for up to 2 years or even indefinitely. Here's how it works. If you sell an asset, you have 2 years window to reinvest the proceeds into a replacement CGT asset. If you don't, the deferred capital gain will become taxable at the 2-year mark. However, if you acquire a qualifying replacing asset within 2-year period, the tax remains deferred until you sell that new asset. In other words, as long as you continue to hold your replacement asset, you effectively defer your tax indefinitely. Retirement exemption under small business CGT. You can eliminate capital gain tax as part of your retirement plan. The concession is called the retirement exemption. You can exclude up to $500,000 of remaining capital gain. If you are under 55 years old, you must contribute the gain into your superannuation fund. But if you are 55 or older, you don't need to contribute to superannuation. Just claim the exemption up to the $500,000 cap. The best part? If both you and your spouse qualify, that could be up to $1 million in exemptions. This is a great way to reduce your tax burden as you sell the assets. Another powerful way to reduce CGT is through the 15 years exemption. This is perfect for business owners who've owned the asset for a long period of time. To qualify, you must own the asset for at least 15 years. The 15-year exemption allows you to completely eliminate CGT, and there's no cap on the amount that you can exclude. Let's go through the summary of the calculation. If you sell your investment property for $3 million with a cost base of $1 million, your capital gain is $2 million. Applying $1 million of capital losses will reduce your capital gain to $1 million. The 50% general CGT discount further reduces it to $500,000. If you qualify for small business CGT concessions, the 50% active asset reduction applies, further reducing this gain to only $250,000. The remaining amount can be deferred or excluded using other small business CGT concessions. If small business CGT concessions are not available to you, you can explore alternative tax strategies at personal level. That leads us to strategy number 6, superannuation contribution. You can contribute cash up to your concessional contribution cap and claim a tax reduction, which directly reduces your net capital gain for the year. The concessional cap includes both your personal contributions and the superannuation contribution made by your employer. If your total super balance is less than $500,000, you can carry forward any unused concessional cap amount from the last 5 years. So from 1 July 2024, the cap is $30,000. Previously, it was $27.5 thousand between 1 July 2021 to 30 June 2024, and it's worth $25,000 from 1 July 2017 to 30 June 2021. If you haven't made any concessional contribution in the last 5 years, you may have an unused cap of up to $137.5 thousand. This means you can contribute up to $137.5 thousand and claim a deduction. For example, without small business CGT, you can have a net capital gain of $500,000 and make a super contribution of $137.5 thousand. Your remaining taxable gain is reduced to approximately $360,000. If the small business CGT active asset applies, your taxable gain is further reduced to $112,500. So this is a result of $250,000 less $137.5 thousand superannuation contribution that you make. Beyond super contribution, you can also use carry forward tax losses to reduce your taxable gain further, or any deduction that you can claim during the year. These 6 strategies can significantly lower your tax liability. In this example, starting with a $2 million capital gain, applying these steps, reducing your taxable amount to just $112,000 capital gain at the end. Hope you loved the series. If this video brought you any value, don't forget to like and subscribe. See you next time.